Hi guys. Today we will analyze FedEx stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also, recent evolutions are not positive. The long-term trend is still negative, but the short-term trend looks positive. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $220 and $200. Next strong support levels are around $155 and $127. Strong resistance levels are around $240 and $264. Next strong resistance level is around $300. In the last month the stock has been trading between $195.40 and $239.20 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 2.6 million. This is a good sign, as it is always nice to have a liquid stock. The stock has been in a downward trend since May 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 10% per year, for last 5 years. We see that the average profit margin of the stock has been around 4% per year, for last 5 years. Also, we see that the average free cash flow to net income rate of the stock has been around -79% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for FedEx Company: bad, average, and good. First scenario. FedEx will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 2%. Future free cash flow to net income rate would be low, 40%. In this case, the fair value of the stock today would be $77. Second scenario. FedEx will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 3%. Future free cash flow to net income rate would be average, 50%. In this case, the fair value of the stock today would be $134. Third scenario. FedEx will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 4%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $209. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 19.09. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For FedEx, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 11. Again, I will use 3 different scenarios for FedEx Company: bad, average, and good. First scenario. FedEx will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 11. In this case, The fair value of the stock today would be $127. Second scenario. FedEx will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 13. In this case, the fair value of the stock today would be $163. Third scenario. FedEx will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 15. In this case, the fair value of the stock today would be $205. As you can see, today the stock is overvalued, $225, even if we expect the company's high performance in future. Both the profitability and the financial health of FedEx get a neutral rating. Also, the stock is expected to show a small growth in revenue in the next 5 years, 6 to 8% yearly. Based on that, the stock looks a bit overpriced at the moment. Also, the stock has been in a downward trend since May 2021, and it can go lower before it recovers. I may consider buying the stock for the dividend when the stock drops below $200. Company strengths. FedEx Corporation is a leading international provider of package delivery, e-commerce and related services. FedEx is best known for its air delivery service, FedEx Express, which was one of the first major shipping companies to offer overnight delivery, as a flagship service. The company has almost 700 aircraft, more than 87,000 motorized vehicles, and nearly 384,000 employees. This large-cap blue-chip industrial company has benefited over the past few years from solid growth in the consumer sector, and especially from growth in e-commerce. FedEx is also one of the top contractors of the U.S. government, and assists in the transport of some United States Postal Service packages through their air cargo network contract. The balance sheet remains solid, and management recently signaled confidence in its outlook with a 15% dividend hike, as well as an expanded share repurchase program. FedEx's massive package sortation footprint, immense air and delivery fleet, and global operations knit together a presence that's extraordinarily difficult to replicate. FedEx's broad-based network allows international customers to reach a number of U.S. destinations not served by competitors. During its nearly 5-decade history, FedEx has weathered multiple economic cycles. While short-term results may suffer, the firm's powerful parcel delivery network is firmly established. FedEx has a return on equity of 21%. This is better than the industry average of 17.6%. Its profit margin of 5.6% is in line with the rest of the industry. The industry average profit margin is 5.2%. Risks. The shares have been exposed to trade and tariff threats and global economic volatility, caused by the coronavirus. The company's earnings are susceptible to swings in fuel costs. FedEx is also sensitive to changes in overall economic growth in the U.S. and abroad. These factors are currently facing elevated downside risk from the Russia-Ukraine conflict. In addition, the company faces the risk of increased competition, as rivals and even former customers, such as Amazon, seek to gain market share in a business that is highly sensitive to price and quality of service. FedEx is grappling with severe labor market constraints that are pushing up wages and creating costly network inefficiencies. Difficult to predict funding requirements for long-term pension liabilities are also a risk. In May 2016, the company completed the acquisition of TNT Express for $4.8 billion. The impact of Brexit, the pandemic and the cyber attack have kept FedEx from improving margins at TNT as fast as had been expected. That work is now expected to be completed this year. FedEx has a return on assets of 6%. This is below the industry average of 7.3%. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 8% on average per year. The earnings per share is expected to grow by 8 to 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.